America is home to 33 million small businesses, the beating heart of communities across the country.
And proof that the American dream is still alive.
This is a show about those dreamers and doers and the communities they serve.
Their real life stories.
Their struggles and successes.
Their grit, determination, and passion.
And the people who fight
to keep their American dream alive.
I'm Alfredo Ortiz.
I'm Elaine Parker.
And it's time for another episode of Main Street Matters,
America's small business megaphone. Hi, everybody, and welcome to another episode of Main Street Matters, America's small business megaphone. I'm Elaine Parker, the president of the Job Creators Network Foundation. New data shows most American workers are losing ground on retirement savings, while only top earners are pulling ahead. Today, we're talking with financial expert Erik Weir about why it's happening and what you can do to protect your future. Erik also has a great new book available titled Who's Eating Your Pie? Essential Financial Advice that will transform your life. Erik, welcome to Main Street Matters.
Thanks for having me on.
Well, the new Dayforce report shows that fewer workers are saving for retirement. What stands out to you most in the data and what's driving the decline?
I think for most people in middle America and typical wage earners, inflation is really beginning to take a toll. If you see of all the money that was released and pumped into the economy by governments around the world to avoid a disaster with COVID, it created an inflationary environment. And I think the Fed has been fighting that. They're meeting later today to discuss even cutting rates, but the impact is still there.
Absolutely. The report also notes that only top earners are increasing their contributions. What does that say about middle and lower income workers' financial stability today?
Yeah, it's more and more challenging because with inflation and with a tremendous amount of money in the monetary system that we have experienced the last 3 or 4 years, that tends to do two things. It tends to elevate the value of real assets, for example, single family home. Which on the one hand, if you own a home, that's a great thing. If you don't own a home, that's a bad thing. It also tends to increase the value of intangible assets, think stocks. So it tends, there's more liquidity, there's a risk on for pension funds, things of that nature. And we've seen higher returns in the U.S. and international stock markets. That being said, that allows the higher earners to be in a position to save more. It allows them to have more financial prosperity. But on the flip side, it becomes more difficult for the average American.
Absolutely. You mentioned the Fed is considering lowering rates again. What are your thoughts on whether the Fed should or shouldn't, and how that will impact Americans' ability to save?
Yeah, I think the Fed, I think they will decrease interest rates today. What the Fed looks at to judge the economy is sort of looking from the rearview mirror. And you've noticed there's been a lot of tension between President Trump and Jerome Powell. And that's because President Trump thinks as a business person where you tend to anticipate what's coming and try to respond before it happens. The Federal Reserve really looks at data from a historical perspective and what's happened most recently. So they're reactionary instead of anticipatory. And I think that's caused a lot of tension. That being said, I do think the data supports a 25 basis point rate cut. I think he'll still remain cautious looking forward and to not have the market anticipate too much more until the data begins to represent the need for more interest rate cuts.
Yeah, I know you're talking about the data, but we've really been flying blind because of the government shutdown. 43 days, 2 jobs reports went by. Next Tuesday, we're finally going to get the long-anticipated October report. And so when you're dealing with no data, basically, how is the Fed going to base that decision to cut rates? And will 25 basis points be enough?
Well, I think for most of the investor climate, most of the people who are seeking to buy a first home are feeling the pinch of tighter wages. It can't come fast enough. And I don't think we get more than 25 basis points at this point in time. Jerome Powell has been reluctant to reduce rates at all, and this, I think, is more than he would like to do. But I think he will do it, and he does have the data to support this. In my view, and to your point, there's less data than historically due to the government shutdown. But I think he's able to look through that and make decisions.
Well, I hope so. Based on the report that we were talking about, do you think the traditional idea of retiring at 65 is still realistic for most Americans?
Well, and that's a great question. I think it actually bodes is different. When people would retire at 65 earlier, the life expectancy typically was much shorter. Now the life expectancy is much longer. And a lot of people at 65 who I've met are not really looking forward to retiring. They want to keep being active and working, has been my experience. That being said, inflation and longevity, I think, come into play with everyone's planning. Is 65 the best age for them to retire or not? But I think if you figure you have 15 or 20 more years typically to live, and you may or may not be confident in Social Security or your own savings, that's certainly what would weigh in to when's a good time for you as an individual to retire.
On 401k front, because that's typically where most Americans are saving for retirement nowadays. They have a employer-sponsored 401k, and they're able to put money away. What do you see, for workers as far as everyday workers making the mistakes that they're making with their 401ks?
I think most people either they're not potentially educated about investing. I think if you listen to Warren Buffett, who's known as one of the world's most successful long-term investors, the manager of Berkshire Hathaway, he's retiring into this year, or changing his role anyway. He recommends his family to buy the S&P 500 index. So it depends on timing. Depends on how long you have, and it'd be nice to talk to a financial advisor or someone in your company who has some experience. But I think most people they buy when things are exciting and make their allocations when things are going well, and when the markets are in the corrective phase, they get nervous and don't want to participate. And those are actually the times you want to participate. So most people make a mistake of being very aggressive when there's a rosy outlook, and very scared when things don't look as good. For example, during the height of the COVID shutdowns, the markets were plummeting. Looking back, that was 100% return on the market would have been had by people who invested at that time. But you pretty much have to view all the media and things you hear, either good or bad, as noise, and just try to see where am I in relation to the long term of the U.S. economy. So I think just time in the market, not market timing, and having some plan where good, bad, or indifferent, you continue to, on a monthly basis, have your wages deducted into a company-sponsored 401k plan.
We represent small business owners, and competition for labor is very high. Benefits can sometimes be the competitive advantage for businesses when they're looking to hire somebody. And a lot of small businesses simply can't offer, retirement plans. What options do you know of that are available for small businesses that are looking to present a more, competitive opportunity to potential employees?
So as a small business, depending on their size, if it's small, 1 or 2, 3 people, they could start what's called a SEP. Just a small retirement plan that they could match or not match for their employees. They could also encourage Roth IRAs, which are IRAs that don't provide for any current tax deduction, but they allow the money to grow tax-free and be withdrawn after 59 and a half tax-free. That's very attractive because if you think about if you're a farmer, would you rather tax the seed or the harvest? And that's a very effective way to plan, though it does not create a current tax advantage. Long term, it's very, very valuable. And then just other IRAs or make-up IRAs, if you're over age 55 generally, or 50-55, then you can oftentimes make an extra contribution called a make-up contribution.
Right, and I know that that extra contribution goes up every year for Americans. For workers that are not able to get an employer-sponsored retirement plan, what are some individual things they can do outside of the 401k?
Yeah, there are a number of things you can do. You can still participate in savings. You can do a Roth, as I mentioned. You can do an individual retirement account if it's not available. And depending on your income, you can do a spousal one as well. If you're married, there are a tremendous amount of options available for people outside of a company retirement plan. And oftentimes, the good news is there's oftentimes more options, because if it's an individual retirement account, you may be able to do it at a Fidelity or a Schwab or a custodian that may have over 1,000 choices. Where if you're with a company plan, they may have 8 or 10 or 20 choices. So it's a much smaller amount of options. So you can be more customized to your individual risk appetite and desires with an individual retirement account.
Are you familiar with a plan called a Unikay, which is for self-employed individuals who don't have employees, and it would be for them and their spouse? I think like a lot of real estate agents utilize those types of products.
It's an excellent plan as well. It certainly is. And that too has you could do it with a custodian and have a wide variety of options.
And it's my understanding that you're able to actually do a match yourself.
You can,
100%. A much larger match than most employers offer.
Yeah, oftentimes as an individual, you can set aside $30,000 to $45,000 a year, depending on your earnings. You can do a 15% salary reduction and some sort of form of matching. If you want to do what are called defined benefit plans, which are tremendously out of favor these days, but they can be done. But they do create a liability for the company. You can name a result you want to get to, and then that gives you the ability to save and put more and more money to hit a desired result. If your investment performance lags your model or what you anticipated, they could cause potentially a hardship where you have to fund at a higher level. But there are quite a few options that remain available for individuals and those who have a small business.
What's your outlook overall for 2026? Do you feel like the economy is going to start to pick up and get better, or you think we're going to still be struggling through 26?
I think the economy is going to improve a little bit as we go into 2026. I think the economy has done well. We haven't had a recession in some amount of time, and a recession is a normal cycle. But I don't see immediate signs that we're beginning a recessionary cycle just yet. I don't think we enter one in 2026. At some point, we will have a recession, but I don't see it in the immediate future. That could always change, but so far, I don't see that.
I know the Trump administration, Secretary Bessent, they're very optimistic about a very strong economy next year, and a very high GDP coming in. What are your thoughts on some of those predictions?
I agree. If you look at the policies they're taking, the attempting to level the playing field with tariffs, other countries, the job investment, the factory investment, the foreign investment coming into the United States, the way that most corporate leaders are leaning into this, they're adopting AI for efficiency. There are so many, in my opinion, markers for a positive next year. That being said, I mean, valuations in stocks are at the higher end of where they typically are. So I'm not saying we're going to have a huge upside in the market. I think it'll be up next year, but we're not coming off a low. Like, it's easier if you say, "Hey, we lost 30% last year. What do you think about next year?" You can have a lot more comfort. But I'm expecting a good economy. I'm expecting a reasonably good market, and I'm expecting liquidity. And we're in a down interest rates cycle. So all those kind of go into the stew that I think we have a positive result next year.
Well, I like what your crystal ball is telling you for sure. You've got a new book called "Who's Eating Your Pie? Essential Financial Advice That Will Transform Your Life." Tell us about the book and tell our audience where they can find it.
Yeah, I wrote the book during COVID. Most people were depressed and kind of dislocated, and I wanted just to make some simple steps that I've learned over time and that I've applied in my own life that could help you make massive change. No matter if you've any difficulty you're overcoming, how to reframe it, how to focus on important things like your faith, family, fitness, finance, friends, and to make a difference and give back along the way. And the book is available on basically anywhere you buy books. They're on Amazon or on my website, erikweir.com.
erikweir.com. Great. Excellent. Well, Erik, thanks so much for taking the time to join us on Main Street Matters, America's small business megaphone. And thank you all for taking the time to join us. Main Street Matters is part of the Salem Podcast Network. New episodes debut every Wednesday and Friday. You can subscribe to the show wherever you get your podcast from, and we'll be back soon with another episode. Bye for now.